Imagine a calendar that not only marks the date, a simple way to keep track of time, but also hints at the likely mood of the stock market, giving you a potential edge in your investment decisions. What if a calendar could whisper secrets of market behavior? The Stock Trader's Almanac, created by Yale Hirsch and now led by his son Jeffrey, is that guided, practical, data-driven book revealing the market's historical patterns and cycles. It's a treasure trove of information for those looking to understand the market's rhythm. It's not about complex formulas, but about understanding how history often rhymes in the markets, offering clues to potential future movements. The Almanac shows that the market isn't entirely random. Certain times of year, days of the week, and years in a presidential term have predictable tendencies. These patterns can offer valuable insights into market behavior. For new traders, it's a friendly guide offering a framework to spot recurring patterns and build confidence. It helps demystify the market and provides a solid foundation for making informed decisions. The Almanac doesn't promise instant riches, but helps you align your strategies with historical tailwinds to improve your odds. It's about making smarter, more informed choices. With charts and clear explanations, it makes decades of market data accessible, like having a mentor whispering insights from 70 years of history. Imagine tapping into a wealth of knowledge accumulated over generations. You learn to use the calendar as a strategic tool, respecting the market's seasonality to your advantage. Understanding these cycles can be a game changer. This script will walk you through the Almanac's key concepts, memorable patterns, and practical strategies for smarter trading. Get ready to unlock the secrets of market timing. The Stock Trader's Almanac is meant to be a trader's constant companion, not just a book to skim and shelve. It equips you with a unique lens, historical probability. By showing the market's underlying seasonal currents, it helps you think strategically instead of reacting emotionally. The Almanac acts as a roadmap, highlighting what's tended to happen in similar circumstances, crucial for building a sound trading plan. Knowing, for example, that certain months are historically strong or weak lets you allocate capital more wisely. This knowledge fosters patience and discipline, helping you plan your trades and avoid impulsive decisions. Ultimately, the Almanac gives you a statistical edge, helping you time your entries and exits with the market's natural rhythms. At the heart of the Stock Trader's Almanac is seasonality, the idea that markets show recurring patterns at certain times of year. These aren't just random occurrences. They are tendencies that have been observed and documented over many years. Decades of data reveal that months like November, December, and January are historically strong, often referred to as the best 6 months of the year. This period frequently sees increased market activity and positive returns. Conversely, September and October are often weak, sometimes even associated with market corrections or increased volatility. These trends are driven by a confluence of factors like holiday optimism, boosting consumer spending, institutional behavior such as end-of-year portfolio adjustments, and the overall flow of money in and out of the market. Seasonality also appears in smaller time frames. The turn of the month effect, for example, is a well-known phenomenon. It shows strength in the last few trading days of each month and the first few days of the subsequent month, presenting short-term opportunities. Pre-holiday rallies are common as optimism and generally lighter trading volumes can lift prices in a predictable manner. Understanding these rhythms gives traders a baseline expectation, making decision-making more robust when combined with other analysis. Seasonality doesn't replace fundamental or technical analysis. Instead, it adds a powerful layer of context and timing to your overall trading strategy, helping you to anticipate potential market movements. One of the Almanac's most fascinating ideas is the 4-year presidential election cycle. Historically, the first 2 years of a US president's term are the weakest for stocks, as new policies create uncertainty. The midterm year is often the most volatile, but the pre-election and election years tend to be the strongest as administrations stimulate the economy. The pre-election year, in particular, has delivered the best returns. For traders, this cycle suggests that the best buying opportunities often come during the early term weakness, setting up gains in the bullish third and fourth years. This long-term perspective helps you look past short-term noise and make strategic decisions. It's a reminder that political and market calendars are deeply intertwined. The Almanac's best 6 months strategy is famously simple: sell in May and go away. Most market gains have historically occurred from November through April, while May to October is often flat or negative. This strategy: invest in stocks from November to April, then move to safer assets from May to October. This approach captures the market's strongest period, driven by holiday spending and institutional flows, and avoids the weaker, more volatile months. Major crashes have often happened in the May-October window. For beginners, this rules-based plan helps manage risk and reduces emotional decisions. While not perfect every year, it has outperformed buy and hold over the long run with less volatility. The Stock Trader's Almanac shines a spotlight on January, viewing it as a potentially crucial indicator for how the year ahead might unfold. It's a closely watched period by many seasoned investors. As goes January, so goes the year. This is the core idea behind the January barometer. If the S&P 500 experiences gains in January, historical data suggests the year is more likely to end in positive territory. Conversely, a loss during January can sometimes signal a more challenging or even a tough year for the market overall. Since 1950, this January barometer concept has demonstrated a surprisingly strong and noteworthy track record. The effect is often attributed to institutional investors who use January to set the tone for the year through their initial asset allocations and investment strategies. Beyond the basic January indicator, the Almanac also closely tracks what's known as the January barometer trifecta: the performance of the first 5 trading days of the year, the Santa Claus rally that occurs in late December, and the overall market performance for the full month of January. When all 3 of these indicators are positive, historical data suggests that the odds of experiencing a strong and rewarding year in the stock market rise dramatically. For those new to trading, these early signals can offer a valuable checkpoint to gauge market sentiment. Bullish Januaries often suggest widespread confidence, while negative Januaries may call for a more cautious approach. It's a simple yet data-driven rule that can help guide your overall trading strategy. The Almanac is packed with smaller calendar patterns that can give traders an edge. The turn of the month effect shows that most gains happen in the last and first few days of each month, thanks to systematic fund flows. Options expiration weeks, especially the week after, are often bullish due to the clearing of market positions. Holiday effects are real. Markets tend to rally before 3-day weekends, with the day before Thanksgiving being especially strong. These patterns offer opportunities for short-term trades or fine-tuning entry and exit points. Knowing these rhythms helps you anticipate market moves and avoid surprises. Layering these insights with broader strategies adds sophistication to your trading toolkit. The Almanac isn't just theory, it's packed with practical advice for new traders. Develop a written trading plan based on seasonal probabilities, defining what, when, and how you'll trade. Don't fight the dominant trend. Focus on buying during strong periods and be cautious in weak ones. Keep a detailed trading journal, tracking your reasons, entries, exits, and outcomes to learn from your own patterns. Patience is key. Wait for the probabilities to favor you before acting. The Almanac is updated yearly, reminding you to keep learning and adapting as markets evolve. Combine its insights with other analysis and stay flexible. Use the Almanac as a foundation, but remember it's one tool among many for lasting trading success. The Stock Trader's Almanac has endured for decades because its data-driven approach works. Its principles of seasonality and historical probability offer clarity in a noisy market. The Almanac democratizes market knowledge, giving beginners the confidence to make informed decisions. Its simple strategies, like the best 6 months and January barometer, are easy to grasp and implement. The patterns it documents are rooted in real cycles of business, politics, and psychology. The Almanac teaches you to read these cycles and position yourself with the trend. It's more than a book of stats. It's a guide to thoughtful, strategic trading built on history's lessons.